Several months ago, we covered Allstate Corporation, which was the Financial Pros' top insurance stock on Trackstar at the time. Since then, it's climbed a bit more than 8%, massively outperforming the market. So what's changed? Hurricane Ian pummeled Florida, destroying homes and leaving billions of dollars in damages. It exposed many insurers, including Allstate, to potentially huge losses. But interestingly, the stock hasn't sold off. And does that mean that the worst is behind the company, or are shares set to slide? Let's take a look at their business. Allstate and its subsidiaries offer insurance products in the US and Canada, primarily on property and tangible assets. The business is about as straightforward as they come. 2021 was one of the best years for Allstate, where revenues grew 20.71% year over year, despite gross margins contracting by 6.2%. The company also took a one-time hit of around $4 billion related to a business divestiture. Otherwise, earnings would look significantly better. The price-to-earnings ratios across insurers for the last 12 months are all over the place. Even the forward PE ratios range from 139.41x for Allstate to 12.88x for Chubb. Yet the price-to-cash flow, and especially the price-to-sales ratios for Allstate look great. In fact, the forward price-to-cash flow for Allstate is forecasted at 4.3x. So why the discrepancy? Well, much of it comes from higher auto-related payouts over the past couple of years. Hurricane Ian payouts, and yet to happen premium increases. Allstate's revenue growth is in the middle of the pack. Its 5-year average of 5.69% is above American Financial Group's and Chubb's, but well below Markel's at 13.52% and Progressive's at 13.49%. Only American Financial Group and Chubb have managed EBITDA and earnings per share growth over the last 3 years. Yet Allstate has the best levered free cash flow 3-year average growth at a whopping 44.51%. Currently, Allstate has some of the lowest margins amongst its peers, except for the free cash flow margin. It sounds odd until you realize it's simply a mismatch between premiums and payouts. Eventually, either earnings will improve or cash flow will deteriorate. In our opinion, this is a 4 out of 10 ranking stock. You wouldn't think it, but inflation hurts insurers. The same claims require more money to repair or replace the same assets, and at the same time, fixed income principals tend to decline as interest rates increase. Eventually, higher interest rates make up for the difference, but it can take years to flow through. Simply put, Allstate is too expensive for its risks. We think investors are hiding in insurance stocks, and the group as a whole is due a reckoning.